I'm delighted to be back at the MBA. I first spoke here, I think almost exactly 5 years ago. It was my very first speech as bank president, and enjoyed the interaction very much. And apparently, enough that I did well enough that I get to come back this time. So I'm pleased to be able to do that. So my speech today has two distinct parts. And the first part is going to have to do with monetary policy. And there's been a great deal of recent public conversation about Federal Reserve accountability with respect to monetary policy. And I view my talk, at least this first part of my talk, as being a natural outgrowth of that dialogue. So American monetary policymakers like myself are employees of the public. And as I'll describe, we're charged with the public's representatives with achieving certain objectives. And in keeping with this employer-employee relationship, my remarks are going to loosely mimic a standard performance evaluation of the kind that takes place in corporations all over America each year. So I'm first going to provide an assessment of Federal Open Market Committee, FOMC, performance over the past 3 years relative to the committee's monetary policy goals. I'll then turn to what I see as appropriate plans for the FOMC in 2015, given the committee's goals. So my remarks are going to differ in a key respect from many, or possibly even most other discussions about the Federal Open Market Committee, about the FOMC. It is common to focus on what actions the committee has taken, such as their decisions about asset purchases or about interest rates. In my view, these discussions about what has been done are really tangential to what I think of as being monetary policy accountability. Accountability in any endeavor, including monetary policy, is not about the actions that have been taken. It's not about the inputs. Rather, it's about the outputs. It's about the results those actions achieve. Specifically, how well performance accords with objectives. And accordingly, my discussion of FOMC performance and plans will be relentlessly goal-oriented. Now, the second part of my speech, in keeping with this venue, it has to do with community banks. It follows up some remarks that I made last year about improving supervision and regulation by tailoring rules and approaches to the actual risks posed by the regulated entities. I'll discuss some recent beneficial changes along these lines and suggest some opportunities for further improvements. Now, as I've said, the second part of my speech is distinct from the first part about monetary policy, but I see them as entirely consistent. In the first part, I'll emphasize the need for monetary policy to achieve the macroeconomic goals set forth for us by Congress. In the second part, I'll describe how tailoring of supervision regulation can help facilitate the Federal Reserve's pursuit of exactly the same objectives. Now, throughout my remarks today, please keep in mind that I'll be expressing my own views, and those are not necessarily those of others in the Federal Reserve System, including my colleagues who serve with me on the Federal Open Market Committee. And I look forward to responding to and learning from questions that you might have at the conclusion of my remarks. Okay, so let me begin the first part of my talk about monetary policy by talking about giving some baseline about the Federal Reserve System and how it engages in monetary policy, specifically, though, honing in, as I promised, on objectives. So 8 times per year, as Kate described, the Federal Open Market Committee, the FOMC, meets to set the path of interest rates for the next 6 to 7 weeks. And all 12 presidents of the various regional Federal Reserve banks, including me, and the 7 governors of the Federal Reserve Board contribute to these deliberations. Now, I was told that the governor of the state is actually speaking next door, so that's what you might be hearing. So, however, the committee itself consists only of the governors, the president of the Federal Reserve Bank of New York, and a rotating group of 4 other presidents. And now that group changes every year, and this year in 2015, I'm not one of the members of the committee. Now, at FOMC meetings, we get together to decide on the level of monetary stimulus for the economy. Now, I'm not going to get into too many details of what that term, monetary stimulus, means, but I'm going to make 2 high-level points. First, when the FOMC changes the level of stimulus, our actions tend to push inflation, that is the rate of growth of prices, and employment in the same direction. If we raise stimulus, that puts upward pressure on both of them. If we lower stimulus, that puts downward pressure on both of them, that is, both on inflation and employment. Second, the FOMC's actions only affect inflation and employment with a lag. And that lag is usually thought to be about 1.5 to 2 years. So what are we trying to do? What are we trying to do by varying the level of monetary stimulus? Congress has charged the FOMC with making monetary policy to promote price stability and to promote maximum employment. The FOMC has interpreted that first goal, price stability, to mean keeping inflation close to 2%. The FOMC's job is to vary monetary stimulus over time in order to meet those mandated objectives. So that's the context that I want you to keep in mind. When we get together, the FOMC makes monetary policy. That monetary policy affects the economy with a lag of about 18 to 24 months, and we're trying to make the policy choices so as to keep inflation close to 2% and to promote maximum employment, to keep unemployment low. That's the context. So I now turn to an assessment of the FOMC's performance over the last 3 years. So I'm going to begin by showing you data on the FOMC's performance with respect to its maximum employment mandate over the past 3 years. So the best known measure of labor market performance is the unemployment rate. So this is a graph of the unemployment rate from the end of 2011 through the end of 2014. Basically, unemployment has fallen over that time frame, and it now is 5.6%. We'll get a read on what it was in January of 2015 at the end of the week. So if we go back to December of 2011, the unemployment rate was 8.5%, and since that time it's fallen to 5.6%. It's a little hard to see this in this graph, but the fall in unemployment was especially rapid in 2014, so last year. But it is worth pointing out that the unemployment remains elevated compared to the FOMC's assessment of its long-run value, but only by a small amount now. The FOMC's current estimates of where the unemployment rate will go in the long run is between 5 and 5.5%. So we're only slightly above that range at this point. Now, the unemployment rate is the most widely known measure of labor market performance. Most Americans, to the extent that they know about what's going on in labor markets and how the country is doing in terms of labor market performance, are probably most familiar with the unemployment rate. But there are good reasons to view it as only one of many useful labor market metrics. Now, to estimate the unemployment rate, as you'll recall, the Census Bureau asks people 2 questions. Are you working? And if not, have you looked for work in the past 4 weeks? The unemployment rate measures the ratio of the second number, the recent job searchers, to the sum of the 2 numbers together, recent job searchers and workers. So this means the unemployment rate can be falling, as it has, for 2 reasons. Because more people are finding work and because fewer people are looking for work. So this is gratifying to see this decline in the unemployment rate, but most of it has come because the fraction of people who are looking for work has fallen, as opposed to because people are finding jobs. Now, how do I know that? Well, we can look at what's called the employment to population ratio, which is the fraction of people over the age of 16 who have a job. Now, if you go back to the end of 2011, the employment to population ratio was 58.5%. It's risen, but only to 59.2%. So arithmetically, this means that the people who are getting jobs accounts for well under half of the fall in the unemployment rate over the past 3 years. Now, the good news is 2014. The unemployment population ratio grew markedly in 2014. So actually, the fall in the unemployment rate we saw in 2014, we can, I think, attribute to people getting jobs, as opposed to people choosing not to look for work. Now, this increase in the employment population ratio is especially notable because of an underlying demographic trend. As a baby boom birth cohort, those people born between 1946 and 1964 ages, the fraction of retirees in the population grows steadily. That demographic force, in and of itself, would have led to a decline in the employment population ratio over the past 3 years. As people age, as the group of people over the age of 16 moves more and more into become older and older, we'd expect more of them to stop working and expect this fraction to fall sort of automatically. The fact that we've seen a rise against that backdrop of the demographic force is really a sign of how much labor markets improved, especially, as I say, in 2014. Now, in Minneapolis, we try to adjust for this demographic impulse I just described by focusing on people who are their primary working years. And so we look at people who are aged 25 to 54. Now, we've seen improvement in this fraction over the past 3 years. And again, the rate of improvement in this fraction was especially marked in the past year. Now, just because someone has a job does not mean they're necessarily fully employed. And there are, again, metrics on that. The Bureau of Labor Statistics reports each month on the number of Americans who are working part-time, who would like to work more hours, but are unable to obtain those additional hours. Again, the good news is that fraction of the labor force has fallen over the past 3 years. And again, I would say that the fraction that we've seen, that fraction declined most notably in the past year, in 2014. So if you put all of this together, I think you can tell a story that we've seen improvement in all three measures of labor market performance over the past 3 years. All three measures, the rate of improvement was especially rapid in 2014. Okay, but now let's step back and come back to our question of assessment of performance. Should Americans view the FOMC's performance with respect to its maximum employment mandate as being satisfactory? I think that's a hard question to answer based on these pictures alone. Employment growth is clearly better than no growth, or worse, negative growth. But we're still left with the question, could the FOMC have facilitated even faster employment growth? Could we have seen an even faster increase in this number through monetary stimulus? To answer this question, we have to look at the cost side of monetary stimulus. That is, we have to look at the behavior of prices. So accordingly, I'm going to turn now to the FOMC's performance relative to its price stability objective. And as I noted earlier, operationally, that price stability objective, promoting price stability, has been translated into keeping the rate of increase of the price level, that is the inflation rate, close to 2%. Even more specifically, the FOMC uses what's called the Personal Consumption Expenditure, or PCE price index, to calculate inflation. This measure of inflation captures the rate of increase in all goods and services, including those related to food and energy. So here's a graph of how PCE inflation has behaved over the past 3 years. There's three main takeaways, I think, from this picture. So we have a green line there at 2 representing the FOMC's target. The first thing to note is that on average, we haven't been at 2 over the past 3 years. We've been at 1.3%. This is well under target. Second, PC inflation has been below 2% for a long time, over 2.5 years. The latest number we got is actually from yesterday, and that was the PC inflation rate for January. Wall Street Journal reported that actually we've been below target for 32 months. Okay, so, as I said, over 2.5 years. The final thing, so we've been averaging below target. We've been actually below target consecutively for 2.5 years. Finally, there was a little pickup in inflation last year. Now, this, we have to be careful here, and this is an important point. Right now, inflation is running. This is just to be. I should have been clear about what this number represents. This is the average of inflation over the preceding 12 months. So that 0.7% you see at the very end is how much prices have grown over the last 12 months. As I said, this represents all goods and services, including those related to food and energy. And as you know, energy prices have come down very rapidly in the past 6 months, and that's weighing in on this figure of that 0.7%. That matters because we're trying to figure out where inflation is going to go in the next 18 to 24 months. I don't expect oil prices to keep falling at the same rate as they have over the past 6 months going into the next 24 months. So it's useful, I think, to strip out, to look at what's called core inflation, to tell me a little bit more about where inflation is going to go in the future. So core is the red line. And you just see the blue line has food and energy goods and services in it, so it wiggles around a lot more because that's basically energy driving it around. But the core line is giving a little bit better sense of where inflation is actually, it's smoother, right? It's giving you more a feeling of where underlying inflation truly is. That's also very low. It's averaged about 1.3%, and it currently is 1.3%. So there's very little sign of inflationary pressure is building in the economy when you look at these numbers. And I'll come back to the problems with that in a second. Now, Now, I want to be clear about your expectations, what your expectations should be here. You should not be expecting us to hit our target every month. But 2.5 years to be below target is a long time. I think it's just very simple to summarize our FOMC's performance in terms of price stability as the committee did not provide sufficient stimulus to hit its inflation target over the past 3 years. Now, what's the cost of that? This persistent underrun of the inflation target creates a risk. It creates a risk to the credibility of the committee's target. For monetary policy to be effective, it's critical that investors and other members of the public believe the FOMC is in fact aiming at 2% inflation, not at some higher or lower figure. Persistent deviations from target may in fact weaken those beliefs. So this is a third of I think a very intuitive point. It's not enough. I mean, you're all business leaders. You know, you have goals you've established for your organizations. You communicate those goals to your employees and other stakeholders on a regular basis. But it's not enough to talk about your goals. The only way people believe that you're actually going to live up to those goals if your actions and your outcomes conform to those goals. And to the extent that they're not, you're going to get some doubts and creeping into the picture. So that's a theoretical argument, but empirically, we see exactly that kind of reduction in FOMC credibility in financial market data over the past few months. So what is this? These are basically pictures of the two kinds of measures in financial markets. One is based off the red line is based off Treasury inflation protected securities, and the other is based off what's called an inflation swap. All of these are measures of what market investors expect inflation to be, not next year, but rather from the years 2020, or 5 years to 10 years, between 5 years from now and 10 years from now. So now at the end of the chart, between 2020 and 2025. Now, why does this matter? Why is this important? So this is not about oil, okay? It's not about what's happening to oil prices in the past 6 months. Nobody thinks that what's happening to the price of oil in the past 6 months tells us about what's going to happen to prices from 2020 to 2025. What this is about is what do investors and financial market participants think about the FOMC's future intentions with regards to inflation? And the main takeaway from both these is that both these metrics have drifted downward over the past 3 years. And they've fallen especially sharply in the past few months, and I might even go further to say especially sharply in the past month. So far, the FOMC has largely failed to take substantial policy action in response to these declines. And the lack of a response creates additional downside risk to the credibility of the 2% inflation target. So you see these metrics indicating there's been a decline in credibility, no response by the committee to that decline in credibility. That, of course, feeds on itself to create a further decline in credibility. So I can close my discussion of price stability by circling back to a question about the employment mandate that I posed earlier. Should the FOMC have stimulated more rapid employment growth? The data on inflation suggests an answer to that question. Recall that monetary stimulus pushes both employment and prices in the same direction. Providing more stimulus, the FOMC could have stimulated at least somewhat more employment growth. But the key is without cost, without creating undue inflation. And I'm sure this faster employment growth would have been welcomed by the American public. So even though employment did grow, and we saw the pictures, especially in 2014, it seems there was an improvement opportunity. The FOMC could have facilitated even more employment growth. Now, my summary assessment is the FOMC underperformed in the past 3 years with respect to both the price stability mandate and the employment mandate. And I'm sometimes asked, what concrete actions could the committee have taken to provide additional stimulus? One concrete action would have been to not reduce stimulus. In mid-2013, the FOMC began communicating about the eventual elimination of its asset purchase program that took place from the elimination, the so-called taper, that took place from December 2013 to October 2014. These communications and the follow-up actions were a tightening of monetary policy. And accordingly, they were associated with sharp increases in market interest rates and reductions in the rates of home mortgage refinancing. So I've discussed FOMC performance over the past 3 years relative to the FOMC's objectives, I now want to turn to the question of how I believe monetary policy stimulus should evolve over the coming year in 2015, so as to best achieve our objectives, the committee's objectives. I'm going to focus on one particular issue. How should the FOMC adjust the target range for the Fed funds rate, the short-term interbank lending rate? As has been true for over 6 years, that target range is currently set between 0 and a quarter percentage point. The main issue facing the committee is, should that target range be raised soon? So to answer that question, I find it helpful to return to my earlier analogy of a corporate performance evaluation. Many employees in America are valued in terms of their performance with respect to pre-assigned goals. They are given a great deal of latitude, though, about how to make choices that will achieve those objectives. And the best employees are the ones who consistently use that flexibility to maximize their success with respect to their pre-assigned goals. The FOMC is an employee of the public. We also enjoy a great deal of latitude, so-called central bank independence. To be a good employee, we should use that latitude to optimize our success with respect to achieving our macroeconomic goals, so that a year from now, 2 years from now, 3 years from now, an evaluation of the kind I just went through the FOMC would look better on that relative to the review I just went through. Optimizing success with respect to achieving its macroeconomic goals. This goal-oriented approach to monetary policy would focus on keeping the economy as close as possible to the FOMC's objectives for prices and employment. Now, a goal-oriented approach has sharp implications for near-term monetary policy decisions, I should say. My own current assessment is it will take a few years for inflation to return to 2% from its current low level. So here we are with inflation. We want to get back to 2%. It's going to take a few years, as I say, for that to happen. As I noted earlier, monetary policy affects prices with about a 2-year lag. Raising the target range for the Fed funds rate in 2015 would only further slow the pace of the already very gradual recovery in inflation. It would also increase the risk of loss of credibility, in the sense the public could increasingly perceive the FOMC as aiming at a lower inflation target than 2%. So given my current outlook for inflation, that inflation is going to be running as below 2% for a few years, I anticipate that under a goal-oriented approach, the FOMC would not raise the Fed funds rate target this year. Now, what about the employment mandate? I would focus on the price stability mandate. Deciding not to reduce stimulus in 2015 would also be consistent with a goal-oriented approach to the employment mandate. Increases in stimulus would push upward unemployment. Such an increase in employment is entirely consistent with the promotion of maximum employment that Congress has mandated for the committee. Now, admittedly, there has been considerable skepticism over the course of the past 5 years about the ability of monetary or fiscal policy to stimulate employment growth. And I have expressed some of those concerns myself on occasion. But look at how rapidly employment did grow in 2014. The job market is finally on a desirable upward trajectory. We're more likely to continue on that trajectory if the FOMC does not tighten monetary policy in 2015. So that is the first part of my talk on monetary policy. And the rest of my talk, I'm going to turn my attention to community banks. Again, I'll emphasize, I don't see these parts of my talk as wholly separate from each other, in the sense that I see community banks as playing an important role in promoting the price and employment goals of the Federal Reserve System. Now, of course, supervision and regulation of these entities is necessary to mitigate the risk of taxpayer loss. But it's necessary for the supervisory and regulatory framework to be appropriately structured to allow community banks to fulfill their necessary economic function. So I'm going to build on remarks that I made in the summer of 2014, where I discussed the need to better tailor supervision and regulation to the risks actually posed by community banks. The main theme in those remarks was that I emphasized the benefits of a statutory approach to tailoring. And I'm glad to be able to report there has been progress along those lines since I spoke in the summer. In that speech, I also provided 2 additional tailoring options, one concerning regulation and another concerning supervision. We've seen progress in the regulatory side, and I'll review those advances. And then I'll conclude with some additional thoughts on supervisory tailoring. So when I talked about statutory approach to tailoring, I meant Congress should make laws about tailoring. And that was the best way to prevent regulatory creep, was to have specific restrictions in legislation to prevent it. Now, the statutory advance with respect to regulatory tailoring that we've seen concerns an expansion in the number of small bank and thrift holding companies that have been exempted from consolidated capital requirements. Late last year, Congress put the vast majority of holding companies, both bank and savings and loan holding companies, with $1 billion or less in assets under the Fed's small bank holding company policy. This means that approximately 25 additional holding companies in Minnesota will now avoid capital requirements. The Board of Governors issued an interim final rule and notice of proposed rulemaking on January 29th of 2015 to further implementation of the new law. Comments on the rule and the proposal are due by March 4th of this year, and I encourage all of you to provide your feedback. So there are several features of the reform worthy of emulation. Congress exempted select small firms explicitly and clearly by statute. And as I emphasized last summer, this is the best way to prevent regulatory creep. The reform has the potential to produce cost savings for small firms in multiple ways, including reduction in capital requirements and potential reductions in the cost of regulatory reporting. And the changes went into effect quickly. Legislation to make the change was introduced around the time that Federal Reserve Governor Trujillo raised this reform option. So he raised this reform option in early November of last year, and Congress passed the law on December 18th of last year. So a very fast time between Governor Trujillo of the Federal Reserve System proposing this, and then actually it's being passed by Congress. So I look forward to the Board of Governors continuing the rapid pace of implementation associated with this particular reform. I see benefits in extending the small holding company policy to some firms with assets of less than $10 billion. Some firms of that size are effectively large community banks in terms of their overall risk profile. And here I'll just pause and I'll underscore, size is not the only metric that matters. We're using size as a way to capture what the risk profile of the institution is. But I do, as I say, see benefits in extending the small holding company policy to some firms with assets of less than $10 billion. I'm also encouraged by the seriousness with which the Federal Reserve and other agencies are taking the regulatory review required under the Economic Growth and Regulatory Paperwork Reduction Act of 1996. And I'd encourage the Minnesota Bankers Association and all banks in the state of Minnesota and the 9th Federal Reserve District to continue to provide suggestions on tailoring regulation for community banks under that review, the paperwork reduction review. So that's the idea for on the regulatory front. But a second fruitful approach is about tailoring in terms of supervision. I worry that our current supervisory methods establish expectations that are too detailed across too many areas of bank operations and too wide a swath of banks. Alternatively, supervisors could concentrate on a smaller number of activities that we believe are correlated with bad outcomes. To be specific, supervisors could choose to focus on rapid loan growth, high lending concentrations, specific high-risk types of lending and wholesale funding strategies, and curtail some of the more detailed reviews at lower-risk institutions. So this would be a shift towards institutions that have a specific kind of risk profile. This shift in focus would generate higher returns to society. And by returns here, I mean in terms of improved safety and soundness per dollar spent on supervision and regulation. To be clear, I'm suggesting a tailored approach, so supervisors would retain the more comprehensive prescriptive approach for larger, systemically important institutions. So let me wrap up, and then I'll be happy to take questions. So 2014 was an outstanding year from the point of view of employment growth. But as I suggested in my discussion, the sluggish behavior of prices over the past few years indicates that there is room for better, even more improvement. I expect inflation to remain below 2% for a few years. That outlook gives the FOMC plenty of headroom in which to use monetary policy stimulus to facilitate continued labor market improvement. Better tailoring of community bank supervision and regulation, especially statutory tailoring of the kind that I discussed today, would also help promote our price and employment objectives. Thank you very much for listening. I look forward to taking your questions.